In this video, we're going to look at a more detailed balance sheet. Whenever we start a balance sheet, we always want to start with our basic balance sheet equation. So assets equals liabilities plus equity. And remember that assets are either current assets or net fixed assets. Liabilities are either current liabilities or long-term debt, and equity is either common stock or retained earnings. These are the six main pieces of the balance sheet. And if you understand these six accounts and this basic template with just these six items, you'll be able to solve any balance sheet problem. So now let's look at it in a bit more detail. Current assets can be in the form of cash, accounts receivable, which remember are sales that we made, but we just haven't collected the cash yet, so we're waiting to receive cash from our customers, and then inventory, which can be in the form of raw materials or finished goods. Current assets are going to be items that we think will turn into cash within the next 12 months. So we will sell the inventory. It can become accounts receivable or we can sell it for cash. Once something is in the accounts receivable account, we're just waiting for our customer to pay us, and then it becomes cash. So again, these are things that we think will turn into cash within the next 12 months. One thing you'll notice about current assets is that current assets are listed in order of decreasing liquidity. Liquidity is how quickly we can turn something into cash without dropping the price significantly, so cash is obviously going to be first. Accounts receivable will turn into cash when our customer pays us, which may be 15 days if we gave them 15 days to pay, or 30 days if we gave them 30 days to pay, and so on. And then inventory would be the last thing to turn into cash because we need to sell it first, it can become an accounts receivable, and then turn into cash. Net fixed assets are going to include things like plant, property, and equipment. It can also include things like patents, trademarks, and goodwill. These are longer-term assets that we don't expect to sell, and in large part, these are going to be the way that we generate our sales. Now let's look at liabilities. Current liabilities can be things like accounts payable. So maybe we've received goods or services from our suppliers and they've given us 15 days to pay or 30 days to pay or 45 days to pay or whatever the case is, but we will eventually pay them. Wages and salaries payable to our employees, taxes payable, and any other notes payable or short-term debt that's payable. And any portion of long-term debt that's going to be payable within the next 12 months will also go under current liabilities. So current liabilities are things that we're going to need to pay in cash within the next 12 months. Long-term debt are liabilities we have but we don't need to pay within the next 12 months. So those are going to be things like mortgages on any property we have, long-term loans, bonds outstanding. Now let's look at equity. So far we've said equity is common stock and retained earnings, but actually that common stock account is referred to paid-in capital. And paid-in capital is made up of common stock and additional paid-in capital. This is the money that's contributed by shareholders or stockholders when they first buy into the firm. So this is the capital that they pay into the firm in order to become shareholders. So here's an example of a stock certificate from the Ford Motor Company. And when this stock was sold, the firm received cash that went into the common stock account and into the additional paid-in capital account. The amount that went into the common stock account was actually very small, and the amount that went into the additional paid-in capital amount was larger. But when we add these two accounts together, that's the amount that the firm received from selling shares. The reason these two accounts are separate is because some states want shareholders to be responsible for the firm if it goes bankrupt. So if we look closer at this stock certificate for Ford Motor Company, we'll see that it has a par value of 1 cent. So generally what firms do is they set the par value very small so that shareholders don't have to be responsible for any more than they've already paid for the stock. Other states don't have this requirement where shareholders are responsible for the firm. So if we look at this Apple Computer stock certificate, we see that it does not have a par value. So in that case, all of the paid-in capital would just go into common stock, which is why the equity account is often broken up into just common stock and retained earnings. The important thing to note here is that you can take that common stock account and the additional paid-in capital amount and add them together, and that tells you what the firm got when they sold the shares. So let's suppose a firm sold shares for $10 and they put a par value of $1 on it. $1 would go into the common stock account and the other $9 would go into additional paid-in capital. But when we add those two accounts together, that gives us the $10 that the firm received from selling the shares. Now we'll move into retained earnings. So retained earnings is made up of accumulated retained earnings, and that comes from the income statement. So if we look here at our income statement, after net income, we pay a dividend. Whatever's left over is the addition to retained earnings, and that gets added to the accumulated retained earnings on the balance sheet. So accumulated retained earnings on the balance sheet is all of the addition to retained earnings the firm has had over its lifetime. Retained earnings also includes accumulated other comprehensive retained earnings, which comes from other comprehensive income on the income statement. And if the firm bought back any shares, then we would also subtract that amount, which is why we have this contra account here, less treasury stock. So this is what a more detailed version of a balance sheet looks like. Because this is a principles level course, most of the balance sheets that you'll see will look like this. So you'll start with your basic balance sheet equation, assets equals liabilities plus equity. Assets will be broken into current assets and net fixed assets. Liabilities will be broken up into current liabilities and long-term debt, and equity will be broken up into common stock and retained earnings. Current assets, you'll generally see cash and cash equivalents, accounts receivable and inventory. Net fixed assets, you'll generally see plant, property, and equipment. Current liabilities, you'll generally see accounts payable and notes payable. And long-term debt, you'll generally just see as long-term debt. Sometimes you'll see it as bonds. Common stock and retained earnings are usually just common stock and accumulated retained earnings. If you know this basic balance sheet template setup, then you can solve any balance sheet problem. We'll have some videos where you can see how that's done. But this is your basic balance sheet template.